To the results presentation of RPC on the financial year just ending March 2017. I got with me Simon Kesselton, our Group Finance Director, and Frank Doornbos, the Group Director Business Improvement, and indeed currently also Interim Divisional CEO of BPI. So before we go through to the presentation, I'd like to go through some highlights of 2016-17. We saw some very good organic growth in the year, a like-for-like increase of 3%, which is ahead of our GDP and indeed, I think, compares favorably with some of our major international peers. It's on the back of continued investments in product design and process technology, which is quite important. That has led, in turn, overall to record levels of profitability, a good return on capital, and indeed a good cash flow generation, and indeed also conversion. We have done a number of acquisitions in the year, and I'm pleased to report they're all bedding in well, with the steady state cost synergies projected for GCS, BPI and Promus increased by €5 million to at least €105 million per annum. The Letica acquisition, which we did in March 2017, which is a platform for growth for North America, has actually made a good start under RPC ownership. Finally, dividend has been increased for the 24th successive year, this time by 50% to 24p. So, the agenda, the next slide, I'll go through straight into the Vision 2020 strategy. So, the first slide shows the progress made in 2016 and 17. I've already mentioned the focus on organic growth, which is the first element of the strategy, which was quite pleasing, and we continue to also spend capital expenditure for future organic growth in attractive market segments. At the same time, we see a consolidation trend in Europe, as well as a globalization trend, which we participate in. I think the key word here is we participate in selectively, but I will come back to that later in the presentation. And we've enhanced our group's platform in the healthcare business through the Plastiape acquisition. We rounded out some market segments through the smaller Jechtenberg and Sanders acquisitions, and we made a successful entry into the flexible segments through the acquisition of BPI. At the same time, we follow our customers in a globalizing market, so we want to create a meaningful presence outside of Europe. I've already alluded to the Letica acquisition. We also enhanced our platform through acquisitions in Australia and South Africa. The latter one will complete later this month. And we followed the major multinational customers in the production of complex coffee capsules in Brazil. So both organically and inorganically, we continue to enhance our presence outside of Europe. At the same time, we've got a skill set that we can leverage also, and competitive advantage we can leverage in non-packaging markets. So in that front, we've acquired ESE, which is a European leader in temporary waste solutions, which also made a good start under our ownership. In November 2015, we acquired Strata Products, which has had a really good first year under our ownership. And we're seeing continued growth in China in electroplated components, particularly for the automotive industry. So we've commissioned a third electroplating line, which should get us some nice future growth. So this is the progress of the Vision 2020 strategy in this year. As we launched this strategy in 2013, and we're now midway through 2020, we've also made a bit of a progress report, which we'll see on the next slide. So how well have we done in terms of organic growth? You can see our compound annual growth rate has been 3.2%, ahead of GDP, and I think also ahead of most of our listed peers internationally. The middle column will need some explanation. So what we did here is try to establish the expected return on the acquisitions we've made since the launch of Vision 2020 strategy. It is purely based on cost. So we've also acquired businesses with an attractive return and growth profile, but this is a conservative estimate, just looking at what have we invested in the businesses and what are the return based on cost synergies. So the enterprise value of the acquisitions we've done was around £2.3 billion. It's at an acquisition multiple which is generally below the market average. The associated acquisition costs, taking everything into account doing these acquisitions, so equity raises, due diligence and the like, have been around £40 million. And the cash cost of realizing cost synergies have been £105 million. So overall, the investment amount is a little shy of £2.5 billion. The EBIT on the return side we've acquired prior to acquisition is 240 million, and the cost synergies to be realised in total 101 million, of which 60 million pounds have already been realised. As the group has grown, 1 billion to 2.7 billion this year to 3.5 billion pro forma, we have seen an increase in central costs, so you have to subtract that from the benefits. So overall, you then get to a post-synergy benefit of around 300 million pounds, comparing to an investment of around 2.5 billion pounds, so a return purely based on cost of around 12% pre-tax, 9.3% post-tax. So it's a good cost-based return, but we also, as I said, we diversified into markets with very good return and growth profiles. Scale in polymer buying is important. Market is consolidating and globalizing. Polymer, you can see that in the graph, represents around 36% of our cost base, and we've grown the scale in that from 310,000 tons annualized to 1.1 million tons annualized. So that enhances the group strategic buying position quite dramatically. So all of that should then translate into good returns, which is why on the next slide, what we did here was to compare the P&L just prior to the launch of Vision 2020 strategy to the one we're reporting on. And yes, you can see the top line revenue increasing by 1.7 billion. It's organic growth, but also acquisitions. But perhaps more importantly, you can see that our EBITDA percentage has improved by 2% points or 200 bips from 14% to 16%, and our return on sales have improved from 9.3 to 11.2%. So I think good enhancement. You see the return on net operational assets have improved from 20.6 to 26%. This is as a function of not only acquiring good quality business, but also investing in organic growth, which drives up that return profile. The ROCE has been diluted, and that is as a consequence of not all synergies yet flowing through to the return metrics, but it's staying well above our weighted average cost of capital, which is between 8 and 9%, both pre-tax. The earnings per share, both on a statutory as well on an adjusted basis, you can see the growth rate has been quite good, over 20% over those years. So in summary, our strategic performance to date shows a good innovation and market-focus driven organic growth, value-adding acquisitions in a market which in itself is consolidating. We strengthened our existing market position. We diversified into adjacent markets with attractive growth and return profiles, and entering into new geographies following major multinational customers. We enhanced our buying position and indeed enhanced our return profile as the return on sales has indeed increased from 9.3% to 11.2%. So overall, I would say that the implementation of our Vision 2020 strategy is progressing well. Having said that, I would now like to hand over to Simon, who will take you through this year's financial results. Simon.
Thanks, Pim. Morning, everyone. Turning on to slide 7, we look at the 2016-17 profit and loss account compared to the prior year. Overall, sales were 67% above last year. The majority of the increase is driven by acquisitions. However, as you will see on the sales bridge later in the presentation, and as Pim has mentioned, there was a solid 3% contribution from organic growth on a constant currency and polymer basis. Adjusted operating profit is £308.2 million, representing a 77% increase and a return on sales of 11.2%. If we examine what is happening to the cost base, we can see as a percentage, wages and salaries and other expenses decreased relative to sales by 2.3%, while materials increased by 1.6%. This is driven by improvements in the underlying group and mix, as BPI sales as a proportion of the group increase. Included in the appendix, we can see an analysis for the last 3 years of costs at 2014-15 polymer selling prices, excluding this year's acquisitions. We can see over the 3 periods year-on-year improvements. Material costs reduced from 48 to 45%, wages and salaries are flat at 23%, and expenses fall 1% to 17%. This demonstrates polymer price variances have been and continue to be passed through to customers, and inflation across the remaining cost base to be either offset by continuous improvement or included within product selling prices. Interest increased to 23 million, in line with the increase in debt to part fund the growth of the group. Non-underlying costs, which are the costs to acquire and extract future synergies and acquisitions, rose to 131.4 million, and I will go through each element later in the presentation to explain their one-off nature. An underlying tax rate of 22.8% was reduced to a statutory tax rate of around 14.7% due to tax relief of 23.2 million on certain non-underlying costs, and by a credit of 19.2 million as changes in the group facilitated access to tax losses from companies acquired in previous years. The result is that adjusted earnings per share rises 54% to 62.2p, and statutory earnings per share rises by 105% to 37.1p. Return on capital is good at 15.1%. The slight fall of 60 bps is dilution from the acquisitive growth of the group. Moving on a page to the sales bridge, we start on the left-hand side with last year's sales of just over £1.6 billion. We then add the positive impact from foreign exchange translation of £181 million. This is driven by lower sterling versus the euro and the dollar. We then align last year's sales on a constant polymer selling price basis, resulting in a 24 million decline. This gives us last year's sales restated at 1.8 billion. We then add on last year's sales for the relevant period of acquisitions made during the year. The 877 million on the bridge is made up of the acquired company's last year's sales of £812 million, plus a positive foreign exchange translation of £68 million, less an adjustment of £3 million for lower polymer selling prices this year. Then taking this total away from this year's sales of 2.747 billion, we see organic revenue growth of £71 million, or 3%. Moving now to the profit bridge, we again start on the left-hand side with last year's adjusted operating profit of £174 million. A similar positive foreign exchange translation impact to that we saw on sales had a positive £23 million impact on profits. In terms of polymer, there was a small headwind during the year, which resulted in a variance from last year's tailwind of £11 million, and I'll detail the polymer variances on the next slide. This leaves last year's profit, adjusted for foreign exchange and polymer, at £186 million, and we then see what's happening in the business in the next three bars. Last year's profits for the period since acquisition for businesses acquired during the year was £62 million. This is net of a foreign exchange benefit of £6 million, partly offset by a polymer headwind of £3 million. Business improvements contributed £84 million. This £84 million contains £28 million of synergy realisation, which leaves a contribution of £56 million from many other variances across our business, predominantly our ability to align contractual terms, growth, and other continuous improvement actions which go to offset the 24 million of inflation we see in our non-polymer cost base. Moving on to slide 10, we look in more detail at the polymer environment. It's worth noting that RPC buy and sell on approximately 65 polymer indices, all in the appropriate currency, but of course all then reported in GBP in our results. Prices move on a monthly basis, but with the selling price change that lags purchase price changes. At the bottom left-hand side of the slide, we can see the headwind or tailwind that has been experienced during the last 3 years. So in 2014-15, we had a 9 million tailwind, 15-16, an 11 million tailwind, but this year we had a small £3 million headwind. An appendix reconciles this across the acquisition made in the last couple of years, as acquired companies obviously have the same dynamics. Looking into the two charts at the top of the slide, we can see why there is a headwind. As prices change monthly, the profitability headwind or tailwind is predominantly determined by the movement of all of the 65 indices during the last 4 months of the year. With the majority of our sales in Europe and the UK, these indices obviously have the largest impact on the group. On the left, we see the average of our two main European indexes move in euro. We clearly see in the last 4 months a mild increase which would result in a headwind. This is in sharp contrast to the large decline shown in the final 4 months of the prior 2 years. On the right, Great British Pounds, which is 27% of our sales. The indexes show a worse profile for the year, constantly increasing during the year, not only due to the cost of polymer in the final 4 months, but also due to a weaker British pound versus the euro or the dollar, where the bulk of polymer consumed in the UK is produced. The headwind is mitigated by increasing the flexibility of businesses acquired and proactive materials management. Turning to slide 11, we look in more detail at the Promans, GCS and BPI synergies and the cost to extract those synergies. On the left, we see the total P&L charge of €190 million. This is increased by €10 million to extract the further €5 million of synergies that Pim mentioned and Frank will detail further later on in the presentation. Of the €190 million, €30 million are asset impairments, and there will be a working capital and asset sales proceeds of €40 million, leaving a total cash out for the project of €120 million to extract an annual run rate of €105 million of savings. On the right at the top, we see the phasing of realising the synergies. We can see 68 million realised over the last 2 years, a further 27 to be realised next year, and the remaining 10 million to be realised in 2018-19. Below that, we see the P&L charges incurred of euro 160 million, with a further 30 million euros to be incurred to complete the projects. In terms of cash, euro 60 million is still to be spent, which is approximately 52 million pounds shown at on the bottom chart. When you see the technical guidance later, you will see the integration costs on other acquisitions and other exceptional items are expected to be just 5 million pounds for 2017-18. On slide 12, we detail all non-underlying costs, including the exceptional items. Exceptional costs for the period amounted to £84.2 million. These costs are acquisition-driven, one-time in nature, and broken down into 4 key categories. Acquisition costs. These are the direct external costs associated with making an acquisition. They are predominantly financial, legal, tax, environmental, anti-bribery and corruption due diligence, plus representation and warranty insurance. The 18.9 million is accounted for by Letica 7 million, BPI 5 million, ESE 3 million and Plastiapi 1 million, with 3 million accounted for by other acquisitions made during the year. This represents just 1.6% of the enterprise value of the acquisitions made during the year. Deferred consideration runs through the profit and loss account. When there is an earn-out as part of an acquisition and the selling owner or management are retained within the business, or there is a change in the expected level of payout. RPC often retains management. During this financial year, we see a credit of £11.2 million. This is driven by the assumed payout for the acquisition of ACE being adjusted from 75% to 50%, partly offset by the start of the Letica earn-out. If we recall, the ACE earn-out is a 4-year earn-out, which required a 4-year EBITDA compound annual growth rate of 15.6% to pay out in full. A 50% provision then implies a healthy level of growth expected. The Letica earn-out in the period was £3 million, and a 100% payout would mean a charge of approximately £4.4 million per month going forward. Other earn-outs were immaterial at £1 million. Promans, GCS and BPI integration costs are the one-time costs to deliver the euro 120 million of synergies from the Promans, GCS and BPI acquisitions. These costs will eventually total 190 million euros, or roughly 156 million pounds. During this financial year, 67 million pounds has been incurred. During prior financial periods, a further 63 million has been incurred, leaving approximately 26 million pounds to follow. The 67 million pounds is predominantly accounted for by severance and redundancy costs of 22 million pounds, asset impairments at closed sites of 11 million pounds, and costs associated with physical asset relocation of 33 million pounds. Finally, we have 10 million of other integration and exceptional costs. Other integration costs relate to the acquisitions where there is a limited effort to integrate them, and other exceptional costs cover a number of items, predominantly the launch of our Brazilian production, costs from a fire at one of our locations, and the refocusing of one of our Netherlands businesses. Looking now to other non-underlying items, these fall into 3 categories. Amortisation of acquired intangibles. This has been driven by acquisition, where upon completion, assets and liabilities, tangible and intangible, have to be revalued at the higher of market value or value in use, with the relevant amount of consideration paid for the business allocated to each asset. Intangibles mostly take the form of intellectual property, know-how and customer contact. RPC amortises these amounts over 5 to 10 years. The charge for the year ending March 2017 was £31 million. RPC had several defined benefit pension plans that are closed to new accrual. Administration costs for these were at £1 million during the year. And finally, non-underlying finance costs are interest associated with the same closed pension funds of £5 million, revaluation of non-GBP earnouts of £10 million, and a small amount of implied interest on deferred consideration associated with earnouts. Now we move to cash flow. We can see over the last 3 years our definition of conversion improves from 68% to 95%, and the statutory conversion, which is detailed in the appendix, improves from 33% to 82%. If we focus on this year, we see EBITDA of £441 million, £45 million of which is contributed by acquisitions made during the year. The working capital of £29 million is the realisation of synergies from the GCS and BPI acquisitions. Going forward, we'd expect working capital to grow in line with sales. These positives to conversion are offset by CapEx of £176 million, of which £16 million is in the businesses acquired during the year. This represents 6.4% of sales and is 1.3 times depreciation, reflecting the continued investment in growth-related CapEx, which has been delivering above GDP growth since the start of Vision 2020. Turning over the page to page 14, we then have the debt bridge. We start on the left-hand side with last year's closing debt of £744 million. We then see the cash flow that I just talked through of £239 million coming in. In addition to that, we see the amount spent on acquisitions during the year of £941 million, and the equity raised to part fund those acquisitions of £624 million. If you're wondering what the £141 million on both of those bars is, it represents the equity issued to BPI shareholders as part of the consideration in that acquisition. Dividends were £62 million, and then we move on to the other £84 million. Other is made up of many items. Two largest are FX revaluation driven by weakened sterling of £36 million and a non-underlying cash provision movements of £39 million. The remaining other items of £9 million are predominantly pension contributions. On page 15, we see the group has headroom under its existing facilities of £1.1 billion, and current net debt to EBITDA is at 1.8 times, with our covenants at 3.5 times. Renewal dates on the right-hand side show no material renewals until 2019/2020. Page 16 shows our segmental and regional performances. The performance in all areas continues positively, in line with the group, but what is apparent from these results is that while the business is predominantly a European packaging business, the contribution from our non-packaging businesses and businesses outside of Europe that leverage off RPC's core skill set return above the group's average at 16.2% return on sales and 16.4% respectively. Page 17 is some newly introduced technical guidance. For this financial year, we include CapEx, depreciation, tax rate, interest, FX sensitivity calculations, and also guidance on non-underlying costs and non-underlying cash provision utilisation, assuming no further acquisition activity. Finally, we move to the 5-year trends, which shows the sales, operating profit, EPS and free cash flow previously discussed, but also shows Renoa continue to increase, now at 26%, and finally the 24th year of progressive dividend, an increase of 50% from last year to 24p. Now I'll hand back to Pim to talk through the market developments.
Thank you, Simon. So how well are we doing in the markets? So on this slide, slide 20, we're now, you can see again the growth we refer to ahead of GDP, I think favourable in comparison to some of our peers, in a market which is growing. And the global plastic packaging market, which is our largest market, is anticipated to grow over 4% until 2020, and indeed over 2% in Europe. And in that context, in Europe we've grew slightly over 3%, particularly doing well in the UK, where it has to be said that post the Brexit referendum and the associated currency movements, our competitive position has been enhanced quite significantly. So that probably will have contributed to a good growth rate there. If you look in the rest of the world, this year was a 1.4% growth overall. This is more a turnkey investment-driven market, and we've made some very good investments for future growth in some turnkey projects. I've already mentioned the Chinese project, the investment in the electroplating capacity. So if I then turn into the next slide, before I do that, I think I need to highlight that we've always said we're targeting a growth ahead of GDP through the cycle, and so the first 3 years, and including this year, we've managed to achieve that. Segmental developments. If you look at the various market segments, food is our biggest segment, and we had a very healthy 5% organic growth rate. We could see higher sales in barrier solutions, convenience packaging, more than offsetting lower spread sales, particularly margarine tubs, which market is at best steady. The market, we see it continuing to grow. Shelf life enhancing solution, portion control, minimizing food waste being some of the drivers. So the outlook is continued growth with a strong demand for innovative packaging. If you go into the non-food sector, 632 million pounds of sales in the last year, around 4% organic growth. Key developments we saw here is good overall sales, particularly in tobacco packaging. We have had flat sales in industrial packaging, but that was particularly due to focus on margins, to really on the back of good market position to enhance the bottom line and not chase volume in a rather mature market. So the market in itself is quite diverse, but we can see good growth in those segments where we see innovation playing a key role. So going forward, we're looking for continued growth. Technical components, really good year, 4% organic growth, higher sales of tools, automotive projects and horticultural products. I referred to starter products a little bit earlier. Perhaps a market trend to pick out is to see that there's an increase in demand for complex automotive products in China, where the Chinese government really wants to source as many products for cars locally, and our ACE business has that kind of capability. So if you look forward, we see a very healthy order book for tool sales and indeed the electroplated products. So these are segments, 1.8 billion, 2/3 of our turnover, which has grown at 4% or better. The other sectors I'll refer to have not had that growth. They were relatively stable in the year. Does not mean that we are not encouraged by the outlook in these segments as well. So if you take them one by one, personal care, a flat year-on-year, 400 million pounds. It is on the back of a year where we grew 8%. So it's more consolidating the sales growth of last year. We saw some moderate growth in personal care, but offset by some contraction in the cosmetics element of that. Overall, this is typically a market where you see an increase in global demand. So if you look going forward, we see good growth opportunity in Asia and North America. Beverage, always been a good category for us, but this year we had the growth, but that was offset by the introduction of a second supplier for one major customer we have in coffee capsules. That capacity is being absorbed. The end product continues to grow, so we expect to assume growth in that particular product category thereafter. This is also a category where we can see some of the GCS products coming to the fore, innovative closures, sports caps and beverage caps. So the outlook again is looking pretty positive. Healthcare, around flat in the year. We had very good over-the-counter sales, but we did have a major contract after 3 years finally cancelled by one of our major pharmaceutical companies who decided not to introduce this drug, so that hampered sales. As you will know, the market for healthcare products is increasing, growing population, elderly population, and through the acquisition of Plasti AP, we can actually see a good growth going forward, particularly in dry powdered inhaler devices, where we've got a good market position. All of that is important. In that is innovation in design and engineering. In our industry, you need to continue to innovate in design and engineering. It's a key competitive advantage we have versus many smaller and less well-invested competitors who also do not have our geographic footprint. Currently, the group has 31 innovation centers and well over 1,000 patents. I've already picked out the patented sports caps and CSD light closures, which are gaining traction in the marketplace as we speak. And there are various other examples of innovation across the piece in all the market segments, which you can see in the appendices, slide 40 to 43. And in case you have time, there is a video, a 4-minute video on our website showing the innovation trends in our industry. You can see that at the bottom right-hand side. So in summary, good organic driven growth, which we aim to continue. Another key question, or two key questions actually, we need to address is our acquisitions. How selective have we been in our acquisitions, and indeed how capable are we of integrating them into our business? So first slide you see here is, I think you know our core acquisition criteria. Key one is strategic fit, which I'll come back to in a little bit later. Our capital priorities and structures is first is profitable organic growth, innovation driven, acquisitions that meet our investment criteria. We have a progressive dividend policy with a cover of 2.5 through the cycle, and for our total leverage to remain at a suitable and responsible level. So, selective and disciplined approach. Since we launched Vision 2020 strategy, we had over 300 opportunities reviewed. Over 200 we rejected without an extensive review because it did not have a good strategic fit. The 89 we did look in depth at, we involved the management teams and we rejected the targets when it did not meet our acquisition criteria. So some of them will again be because of strategic fit, some of them will have been simply because the price was too high. So in the end we acquired 16, which is only 5% of the opportunities that we've seen, and we do an in-depth due diligence. We then hand over to central procurement and the divisional management teams, and as I said before, we generally are also selective on price we pay for our acquisitions. So the next slide is quite busy. What it aims to project is our various product market combinations we have currently. There's two axes. On the left-hand side is how good is the competitive position, weak, strong, generally driven by market share, and how attractive is the market in terms of barriers to entry, growth rates, return profiles. Over time, RPC has worked through its restructuring program, RPC 2010 and Fitter for the Future, to not get into the left-hand segments where you got low market attractiveness and not be in a weak competitive position, i.e. be in market sectors where you add value and you're not a price taker. These blobs, these market segments, they move around. Coming back to what I said earlier, innovation is quite key to keep them there, if not move to the top right-hand corner. In terms of our acquisition, of course, we try to avoid where there's a poor strategic fit, hence we discounted over 200 of them straight out of hand. There's a potential strategic fit where there's a good market attractiveness, although starting from a relatively weak position, and you can see where we position our product market combination. So strategic fit is important. We are being very selective in a market which in itself is consolidating and indeed globalizing. But we have done 9 acquisitions in the year, so I think the next key question is, okay, if you accept this fact, then how well do we integrate all those acquisitions in a short space of time? Slide 28 shows you our organization structure. We have 7 divisions with 35 strategic business units. All the divisional and SBU management team focus on specific product market combinations. We've got good group control and governance systems in place. The divisional structures are underpinned by a central back office function and a group procurement function. So we have what I would call a mini RPC sector management approach, which matches this industry structure, which is not a homogeneous industry, but there's many segments and you need to be very selective in which you want to grow organically and which you want to indeed grow inorganically. So if you then look at the acquisition we've done, over the larger acquisition we've done over a space over the last 18 months, you can see here on the left-hand side our divisional structure and then the acquisition spread out in time. So GCS we did actually in quarter 4 of 15-16, so March 2016, impacted the Bramlager division, has been integrated. BPI, which we did in Q2 in August 2016, has formed its own division, Management Retained. ESE, in Promens division, integrated a standalone strategic business unit, again, Management Retained, and the same applies for Letica, which is impacting the Superfos division. So I think it's important to realize that the larger acquisitions are spread over time and across different divisions in an industry which does need a segmented and a disciplined, decentralized approach. So, with that having said, I think it's important to look at integration capability. Some case studies as acquisitions we've made and who are now in a relatively advanced phase, and indeed, how did we achieve the extra 5 million euros of synergies. With that, I hand over to Frank Doornbos, our Director of Business Improvement. Frank?
Thank you, Pim. Okay, let me walk you through our integration capability. It all starts with our selective approach towards acquisitions. We're acquiring strong quality businesses and retaining key management. As highlighted by Pim, our divisional structure creates multiple growth platforms. The acquisitions are spread both by division and in time, enabling the divisions to manage those integration processes successfully, and we are replicating the business improvement structure within the divisions. So, from the group resource, we become more a facilitator. Our central back office support functions and procurement are strengthened over time and are scalable. And as in all cases, the proof of the pudding is in the eating. We do have a strong proven track record of quickly and successfully integrating businesses that allows us to realize the associated synergies. So to summarize, the group is able to absorb multiple acquisitions. On slide 31, we have two types of acquisitions highlighted. On one side, the consolidation acquisition, where we have intensive integration work streams, and on the other side, the plug and play, where the integration workload is limited. In consolidation, the case showing the Promens acquisition as acquired in February 2015. The results of Promens pre-acquisitions was a 5.7% return on sales with 14% RONOA. The actual numbers on the year we report on, we have a 10.3% return on sales and 25% RONOA. The drive behind this is, besides the hard cost and purchase synergy, is the implementation of a clear performance and innovation-focused management style. The product portfolio has been bottom sliced, and in markets where we have a good position, like in industrial packaging, we went for margin enhancements, delivering a strong result and return improvements while a net flat top line. Promens is now set up to resume growth in their chosen markets, focused on added value business through design and engineering. On the right-hand side, you've got the three plug-and-play cases, which are the ones which have been acquired between December 2013 and June 2014, for which the integration has been completed. The sales and profit growth has been driven by the strategy of the existing management and the cost advantages realized through purchasing synergies. Their access to RPC's best practice, customer base and technology accelerated their success. The businesses have established an attractive sales growth and return profile, and their growth is continuing, particularly in China and in the US. These plug-and-play acquisitions need a minimum of business integration, meaning we've got another lot to do with them from an integration perspective. Moving on to the current integration program of Promens, GCS and BPI on slide 32. The hard cost synergies are now projected to be at least 105 million euros. This is 5 million euros higher than our prior projection, and this relates to the plans of the business optimization of the BPI group, which have now been finalized. The 105 million euros is 6% of the acquired turnover and more than double the originally announced 42 million euros. In addition to the best practice and purchasing synergy, the cost synergies are realized by removing the duplicate overhead and optimizing the manufacturing footprint, which has resulted in 16 site closures and a headcount reduction of 845 FTEs. The synergy programs and the work streams are executed by the divisional teams, and the central team is facilitating and supporting them. On the right hand, we've got the progress of the year, and with the additional 33 million delivered, 33 million euros delivered through cost synergies, progress in the year has been good. However, there's been an extensive labor dispute at our Pulheim site in Germany, which has caused us a slight delay of the projected synergies for next year. The duplicate overhead of both GCI and BPI Group has been removed. GCS is operational, fully integrated within the Bramlager division, and the BPI Group is led by myself as interim CEO. And the BPI Group has been reorganized into 4 market-focused businesses, which have the emphasis on operational excellence and innovation to achieve further added value growth. At the company, to maximize the purchasing synergies, flexibility in raw material is essential. This has been enhanced in all acquired businesses. 2 smaller businesses, one in India and one in Northern Ireland, which came with the acquisitions, have been sold as part of active portfolio management. On this point, I'll hand back to Pim for the summary and outlook.
Thanks, Frank. So, turning to the last slide. Vision 2020 is progressing well. We have good profitability levels and cash generation levels. The acquisitions continue to add value. Very pleased with the GCS and BPI performance. Letica, we're confident will provide a platform for growth in North America. Made a good start under RPC ownership. We continue to look for further opportunities in a market which is consolidating and globalizing. And the new financial year has started in line with management expectations. April, across most business, impacted by lower activity level around Easter. May more than making up for that. So, on that note, I'd like to open the room for questions.